Chris Zaccarelli, who's Chief Investment Officer of the Independent Advisor Alliance, and Subhadra Rajappa. She is the head of U.S. rates strategy at Societe Generale. Welcome to all of you. But Subhadra, I'd like to start with you. We've been trying to figure out what's going on today. The market's looking at this as things, maybe we overreacted last week, but you still think that there's a recession that's going to happen in the middle of next year.
Yeah. So I think that over the near term, the market might have overreacted, because if you look at where 10-year Treasury yields, where the fair value for 10-year Treasury yields, it's close to 2%. We're at 160. So it does look very rich relative to fundamentals. But if you look ahead, and if you look at sort of the 3-month 10-year part of the curve, yes, we've been talking about the 2s, 10s part of the curve, inverting last week temporarily, but the 3-month 10-year part of the curve has been inverted since May. So that to me tells me, and that's the metric that the Fed looks at, and Fed's own studies show that anytime that part of the curve inverts, a year after that, growth tends to slow down quite meaningfully. And based on that, we think that there's a good chance that the U.S. economy goes into a recession in the middle of next year.
Chris, what do you think?
I think that's a bold call. I mean, there's definitely enhanced recession fears, and you can look at that signal of the yield curve inverting last week, although temporarily. But again, it's enhanced recession risk. It doesn't necessarily mean that we're going to head into a recession. So whereas before maybe the probability of recession was somewhere around 20%, maybe now it's 30 or 40%, which is definitely getting higher. But for there to be a recession next year, we're going to really have to see a slowdown in the consumer. We're going to have to see enhanced or increased trade tensions. And at this point in time, it doesn't look like, from where we're sitting, that we're going to have a recession imminently. But I do agree that the risk of recession is definitely elevated at this point.
Jason, if you look at that, that's still a 40% chance that a recession might come up, even in some of the more dire expectations, but 60% chance that it doesn't. Where do you kind of fall in this camp? What do you think is going to happen?
I mean, look, the question is what kind of recession we're going to get going forward. What I worry about is we've pulled forward so much credit creation in this country and globally. 95% of yields available in the world are in the United States. Everywhere outside the United States, developed markets, on average, sovereign yields are negative. So I don't know what the tools will be going forward. Lower rates is not going to have much of an effect. So for me, yeah, consumers are key. They're much healthier than they were certainly in 07, 08. But we're in a bit of an earnings decline, maybe an earnings recession. And I just look at manufacturing globally, below 50 PMIs. Those are really negative signs.
Hey, Chris, we can talk about this till we're blue in the face, but I think the one question investors really have right now is, what do I do? Should I buy stocks now, or am I risking losing everything because I'm buying at the very end of a long bull cycle?
Well, I don't think you're risking losing everything. I think you do want to be a little more cautious. You want to look at the signals that the markets are sending you. But again, I think at this point in time, it makes more sense to go towards more quality type companies. So look for those companies that have stronger balance sheets, more of a moat around their business, your more traditional type of value type stocks, but those kinds of companies where they could withstand a recession if one does come. So again, maybe now is the time to upgrade your portfolio as opposed to necessarily making a go to cash or go all in decision. I think it makes more sense to improve it.
Improve it how?
So again, improve it by looking at your portfolio. If you have things that are very cyclical, if you have things that are not going to withstand a recession very well, try to move into more quality type companies. So again, upgrade the quality of your portfolio, looking at the types of businesses that you own, looking at the stocks that you own and the bonds that you own, and potentially look to get less risky, heed some of those cautionary signs while not necessarily going and raising a ton of cash.
All right, Chris, Jason, Subhadra, thank you all for your time. It's good to see you.
Good to see you.